This interview is for information only and should not be considered as investment advice or a recommendation to buy shares in the company featured. Welcome to this Stock Box interview.
Joining us today is Paul Welch, of course, the CEO of Nostra Terra Oil and Gas. Hi, Paul. Welcome back. How are you doing?
I'm doing well. Thanks for having me back today. I appreciate it.
No, good to be talking to you as always. So let's just first of all catch up on some of the recent news. So of course the loan that was RNS the other day. So as I understand, this was a loan that effectively the term was expiring, and you had to effectively renegotiate the loan effectively, but really nothing fundamental has changed.
No, right. So we had a line of credit with a bank. It was it expired at the end of January, so we had to get it renewed. But we could have renewed it for a year, 2 years, 3 years. They essentially renewed it for 3 years, which is the full term that we were looking for. Increased its size, so it's 10 million. We have about 4 drawn on it at the moment. So and the interest rates didn't change, the terms didn't change, so it was a good thing. I mean, again, it was. From our perspective, it showed a lot of faith in the business, and so we were super happy to continue the relationship with Wofford, who's our primary lender. So it was a good thing for us.
Okay, good. And I mean, would you be looking to use that facility, or is it just the fact that it's still there, it's debt? Because I know you wanted to repay it back.
Yeah, no, we don't really want to add to the current indebtedness of the company. So right now we have about $4 million of debt. Which is sufficient given our cash flow. I mean, it's a portion there. It's manageable. If we did some kind of acquisition, maybe some interim financing or something like that, potentially. But at the moment, it's just there. We would prefer to start paying it down. As our production increases, our cash flow has increased substantially with this workover program, which I'm assuming we'll talk about here in a minute. We could get up to about $200K a month in generating cash, and so at that point we'd start paying it down. I think so. Okay. So it's good to have, but and again, who knows? If the world end oil prices go to $10 a barrel or something, it's just good to have it there in case we need it. But
okay. And good, I guess, as well to sort of see effectively a bank's valuation on the company, really, and the project.
Yeah, that's a good point. So to get the loan, we have to do a reserve report, and then that reserve report's updated every 6 months. So at the bank's prices, which are lower than the current market prices, we had an NPV 10 of $10 million, right? The market cap of the company at the moment is plus or minus £2 million. So you can see there's a tremendous gap between those two valuations, and part of my responsibility here is to kind of close that gap. I mean, we think there's a lot of value in the share, and we expect that we'll close it at some time. We've kind of we've doubled the value of the company here in the last 6 months. We need to double it again to get people closer to what we think is a proper valuation of the company. But the NPV 10, just so it's clear, was kind of before the first workover program, so that the NPV 10 was done as of December 1st. And most of the response from the workover program, the first phase workover program, was after that. So the next time we get the reserves done, which will be in May, I think we'll see that NPV go up. Okay.
And the 10 on the NPV, what does that mean?
That's the discount rate. So that's NPV 10 is the 10% discount rate, right?
Okay, 10% discount. Okay, that makes sense. Okay. I saw a question that did pop up, which is why didn't you take the facility rather than do the discounted raises? But is it because at that time, effectively, the facility was maxed out?
The facility has certain terms and conditions. At the point that we could have used some of it, it was in our mind maxed out. We wanted to, there was a couple of reasons. One is we wanted to get some new shareholders on the register, right? People that believe in the story. There was a lot of people that had been in the story for a long time that I think had grown tired of it. We needed some new support. We got some good shareholders on the register, and so it was. So that's why we did the raise. We wanted the support because, again, as we continue to grow, we may have to go back to the market again. We wanted to make sure that the people that got in were richly rewarded, and if we had to go back out another time, that they would be there to support us because we delivered for them. So that's why. So it was a combination of really we're kind of at the max we were comfortable with on that facility, and then we needed some new shareholders on the register.
Okay, I see. But let's just talk about some of the workovers that's been going on then. So I want to bring up this slide because you made a presentation recently, which
Yeah.
I thought was really quite good, really quite clearly setting out the state of the company and the investment case effectively. So here we're looking at the different workover programs, plus then getting into the Falcon 3 drilling, which is coming in theory later on in the year with the sort of proposed dates there. So can you just sort of confirm what we're looking at here on this slide?
Sure. So again, this is thanks for this. This is a great slide. So the area in blue we're shown there is kind of what we've done. So this is the phase one workovers, and that is kind of essentially in progress or done at this point. In the phase two workover program, again, it's another 5 wells, 2 of which are done. There's 3 to go, and then Falk 3 is the development location that we've identified. That at the moment we have it kind of teed up to do mid-year. That takes some discussion with our partners, so that date may slide around a bit. But I think the important point of this is that if you look at a couple things here. First of all, when it says netbacks PM. At $75 a barrel, which is what this was run at, we make almost $50 per barrel in profit for each barrel that we generate in Pine Mill. So 48.60 is the number. So the more barrels we can generate, the more revenue we deliver. And if you look, at the end of the phase 2 workover program, we're currently making about $20,000 a month of profit, or 22. At the end of phase 2, we're making 100. Right.
Okay.
And then if we add on Falk 3, then we're up to almost 200K a month, so doubling again. And at that point in time is when we just mentioned, we start to pay down debt. We start to, really grow the business. So you can see how it kind of steps up, and there's kind of a logic to the program that we've done. Remember, all the wells that we've worked on here, every one of these wells was idle and not producing a single barrel before we started. So these are wells that were just sitting there, just opportunities. We've taken these opportunities with the help of our shareholders and the capital they've provided us, and returned these things to production. So we already have 30, probably 35 at the moment. We've got 2 more. The next 2 wells should be delivered between 14 and 15 each. So that's potentially another 30. And then we have another 20 on top of that we'll get to in the part of the phase 2 workover program. The Falk 3 well, again, if successful, that will deliver another 35 to 40 barrels a day. So we've got a lot of production ahead of us here. And again, these are just, opportunities that we've already identified. It doesn't include anything that we'll see from the interpretation of the 3D seismic over the field that's currently ongoing. Right.
Okay. So these are all, sorry, I said that it was drilling. It's workovers. It's all workovers. It doesn't include future drilling.
These are all workovers with the exception of Falk 3. Falk 3 is a new well that we'd have to drill, but phase 1 and phase 2 are all just workovers.
Right,
and again, the other thing too is that they're idle wells. So, they're just sitting there. They have potential, but no one has taken the opportunity over the last 5 years to return them to production.
Okay. And looking at that, I know I'm just drawing an imaginary line. July, is that when you're looking to perhaps drill?
July is when we are looking to drill the Falk 3 and then turn it on in August. So that's what the assumption is there. But again, that requires, you need our partner to get on board with that. That discussion has started. They're looking at it. We're providing them maps. We've done a lot of technical work on it. We're pretty confident that it's there. It's just we need to get their buy-in on it. So they're 2/3. We're 1/3 of that well. So we'll see how that goes. But we're pretty comfortable that it's there. We just need to get them on board with buying it. And again, we don't know what their budget cycle is, but now is the time to start discussing it with them, which is what we've done.
Right. So those discussions are effectively starting now to get a sense of their interest in funding this come the summer.
Correct. Because they're 2/3 and we're 1/3 of it. So and again, these aren't huge numbers. It's a completed well cost is $1.1 million. Again, we're onshore Texas. Things are cheap. And so, our portion of that is, $350,000 plus or minus, but they're the other, $700,000. So, we have to look at what their budget's like, but they've been a very successful company. So I'm sure they have some cash available to do it.
Right. Okay. Well, we can expect to hear news on that in terms of indeed how, you're going to effectively, work that and fund it effectively. It could involve perhaps another raise, could it?
Potentially, but again, let's see how prices do and how our cash flow works. We would prefer to do everything out of cash flow going forward, but we'll see how it works. Timing,
sure.
See how timing, how prices, that sort of thing. It could be another raise, but we're not going to do any more discounted raises. We'd prefer to do no more raises, but I think that's unrealistic. At some point, might have to do one. But the super duper discounts that we had to do before because basically the company's reputation wasn't great. Those are over. So
Yeah, you mentioned that before. Yeah, so I'm glad you're sort of reiterating
yes.
the discounted raises. But as you say, with getting to a sort of a net back of circa 200,000 a month, then yeah, you hopefully should be able to fund at least a portion of that drilling through existing cash flows. Yeah. Okay.
Yeah, for sure.
In terms of completing that phase 2, then I think last time we spoke, you were talking about water flooding one of the wells here that was going on. But I think you've taken a bit of a pause as well to do some little niggly maintenance issues before you carry on finishing.
Yeah. What we mentioned to before is that we've done two of the next 5 in phase 2. We've paused at the moment, so we let the rig go while we deal with a bunch of other maintenance things that we have to do in the field, because the team hasn't changed in size from when we started the workover program, where the field was just operating, and so they've been going at it since the last week in August. Essentially full out on these workovers. So they've other things have happened that facilities have little niggles in them, that sort of thing. So we're trying to get all those things up and running to make sure that we are we're operating at a very efficient level. And so we've taken a pause for probably 2 weeks, 2 maybe 3 weeks here to catch up on all those things, and then we'll bring the rig back in the field, start the last 3 wells in that second workover program. So
okay, so
again,
looking to conclude that.
We're looking to conclude it, I'd say, at the end of the first quarter, maybe early second quarter. It just depends. The first 5 wells we did were just basically, let's call them simpler workovers. You just run in the hole, maybe cement it, change the purse, change the tubing string, change the rods, put a pumping unit on, that sort of thing. Cool. This next round are wells that have holes in the casing. So we have to run a new string of pipe in the hole. So they're more expensive and they're a little more complex. So we wanted to do those all together, and so that's what we've been doing. So they take a little bit more time. They're a little more costly, and they're a little more technically intensive. But we've managed 2 of them, and they've been very successful so far. So we're pretty psyched up about that. So,
and then at the end of that phase, and you expect your target. I know at the minute you're sort of doing circa, let's say, 125 barrels of oil per day. You're looking to get that to about 150.
Yes. So at the moment, we're running 120, 125 on kind of a daily basis across, all the assets. Where we should get that up closer to 150, 160.
Okay.
Again, that's pre-FALC, and then if we add FALC, that would be on top of that. But that's what we're targeting at the moment.
Okay. Can you do a quick breakdown of Pine Mills, FALC, and West Texas in terms of oil per day?
So at the moment, just in round numbers, Pine Mills will be 80, the FALC area will be 30. And then West Texas will be 10. That's kind of the way it sits, in any one day, Pine Mills could be 85, and, West Texas could be, 7 or 8, and it just varies. But what we're trying to do in the field is improve the reliability. So we have, many more days right at the peak level at, 80, 85, 90, towards 100. So at the moment, because the field hadn't been maintained properly for almost 5 years, we have days of 100, don't have days of 70 because something happens, something breaks. So we're just trying. When I say we're getting all those niggles out, it's just we're focused on reliability and investing in that infrastructure to make sure that it runs consistently day to day, and that really helps generating revenue because we don't have any down days. Our reliability is increased substantially in the last 6 months, and that's what we're going to continue to do.
Well, thank you for that. Investors can, of course, go away and do their own maths. Just quickly looking at myself, the numbers are out there, your netbacks are out there, and it does work out to just under $200,000 per month there. So the numbers are checking out quite nicely. So if I just think where we are now, point A, let's call it, and you want to get to, let's say, point B, which we're going to say is 150 barrels of oil per day circa, plus drilling another well in the FALC. What does it take to get from point A to point B in terms of, I think, what are the metrics involved? Cash, workload, and timelines.
So from a cash perspective, we've got 2 more workovers, which are going to be another, $150,000 each, and then we've got the FALC. So we got 3 more workovers, which are $150,000, and then we've got the FALC well, which is another $350,000. So that's kind of the capital perspective there. From a time perspective, it'll be the end of the first quarter before we'll finish the second phase workovers, and then the FALC drilling has been slated for July, with the production starting in August, and so that's our budget forecast for 2025.
Right.
and that's what the numbers look like. So yeah, that's our plan. I think the things we have control over are the workovers. We can control those. What we don't have control over at the moment is the timing on the Falkwell,
Yeah.
and that thing can slip in time. I don't think it'll come forward. It could go backwards, but at the moment, I think it's kind of where it should be based on the preliminary discussions we had, what we think our partners are going to do. So I think the forecast that you've just shown on that slide is what we're using as our internal forecast, and I think that's the most accurate that we have at the moment. We haven't had any information to change what we did back in November, December when we put that together. So so that's what we're targeting at this point.
Okay, good. Well, that clears point A to B. In terms of funding, the phases that the workovers are covered, the actual drilling will be determined later, a mix of different means. Okay, no, that's fine. Just a final question. Premier Milton, of course, we know are a significant shareholder now in Nostra Terra. They supported both placing, but they've also been buying on market, which I think says quite a lot as well. Perhaps a value proposition that they see. I know you're quite amazed at the value gap between the NPV, the cash flow, the fact you're positive cash flow, the fact that you're profitable, the fact that the market cap is sort of circa 1.5 million or something. A lot of the juniors are struggling at the moment. We can see it all the time. Low market caps. Have you had a conversation with Gervais? Has he expressed sort of why he's interested, why he wants to buy on market?
So I mean, Gervais. I mean, again, Gervais can speak for himself, but in my conversations with him, he likes cash flow, right? And he likes to invest in things that return, return what you've invested within a year. Most of our workovers, if not all of them, are fall in that category. In the case of, we only have one workover that's got about a 14-month payout. All the rest are under a year. And then in the case of the Falk 3 well, the payout of that is 6 months. So, everything is short-term payout with high IRRs. And I think that's what Gervais likes. Gervais likes cash flow. And so those are the things that he's invested in. I think from his perspective, he supported us when we really needed it that first round, also in the second round. And then the share price moved up. And I think he was rewarded for his faith in us. And so he's continued on. So I think he likes a values play. And so I think at the moment we're a value play because our market cap is so disconnected from essentially the NPV of the assets. So I think that's what he likes, but you have to talk to him. He's great to have as a shareholder and we enjoy our conversations with him. So I think he is our biggest shareholder now. So, that's fantastic. And so, we're happy he's involved and we're happy for his advice. And so, it's a real win-win to have him on our shareholder register. And again, when we did that first raise, that's the type of investor we were looking for, someone that, is going to be there for the long haul. And so we'd like other investors that are out there listening to this, if you're there for, look, a multi-bagger, perhaps, this is an alternative, NTOG could be an alternative for you. So,
okay. Well, thank you. And we do hope to speak to Gervais fairly regularly throughout the course of this year. So we're going to be talking about what he likes in Nostra Terra. And of course, looking forward to following what you're doing during Q1. Would you plan to go to site, Paul, yourself, to oversee some of these workovers?
Yeah, sure. So I'm in Dallas at the moment. So I go to the field probably, once every couple of weeks and see what's happening in there. But the field is staffed with some very competent people. So it's more just a discussion about how we're going to do what we're going to do it. It's more of a planning thing for me. Their execution is really down to the field. They do an excellent job of it.
Okay,
so
good. Well, thank you very much for joining us for that update. Paul Welch, the CEO of Nostra Terra Oil and Gas.
All right, I appreciate it. Thanks again for having me on.
If you enjoyed this interview, then give us a thumbs up, a like or a retweet. Subscribe to us on YouTube or follow us on Twitter and hit that notification bell to be the first to know when we release new content. There's loads of great content on our website too, across all our programs at stockboxmedia.com. Thank you for watching.